I'm with a company called Heritage Financial Group. I'm the owner, one of the owners. It's our family firm. Been doing this for almost 15, 20 years now. And Kari invited me. I'm a financial planner, but our niche that we've kind of carved out is working with real estate investors. And we do real estate financial planning. It's kind of a twist on normal financial planning. And that's what she invited me to talk to you guys about. I know you had some other speakers that have talked, I think, about exchanges. You had a facilitator on recently. And because I deal with a lot of 1031 exchanges in my business and a lot of turnkey real estate. I think that was one of the reasons why she invited me. So thanks, Kari. Basically, if you guys have questions, let's keep it pretty low key. If you want to chime in, if I'm talking about something and it's not making sense, or you want to know something more detailed about it, don't hesitate, chime in. Otherwise, I'll ask for questions again at the end. So, but I kind of enjoy these more when it's a conversation. So, yeah. So with that, just a little background on us. Like I said, we're a financial planning firm. It's our family firm. We were founded in 1986. That was my dad and my father, actually, and our CPA, and there are a couple of other advisors, and basically been around since then. I joined in 2005. We've been providing financial planning and investment management for all those years. We service clients primarily in the Twin Cities and Denver. I'd say probably 60% of our client base is in Minneapolis, St. Paul area, about 30% in Denver, and the rest is remotely across the country. I do a lot of Zoom meetings. Well, now they've turned into Zoom meetings. We used to drive around, or else we used to do just a lot of phone call meetings, but with Zoom, it's great. Over the years, we've kind of developed a specialty niche of working directly with real estate investors. And I'll kind of explain more in a later slide, kind of how we settled on that. As far as myself, like I said, I've worked in the financial services industry since 2005. I've been directly advising clients since 2007. A couple of years back, just a little side note, I started partnering with a CPA firm in San Jose, California, preparing taxes remotely. I did this primarily because I wanted to improve my tax knowledge, not because I have this driving desire to do taxes. I don't know many people who do. I think they're fun and I enjoy it, but my end goal with it was really to just help better my tax planning strategies, know more about taxes. I'm working to become an enrolled agent with the IRS, and then we'll probably start our own tax planning, our own tax preparation firm as well, or wing of our firm as well down the road. And then I live in Arden Hills with my wife and 2 kids. So the one thing I will say with the website, I really invite you guys to check out the website. Everything I'm talking about here is on the website and in greater detail. So we worked really hard to have a lot of financial planning websites. You kind of go to them and you really don't get an idea of what the company does. We've worked really hard to outline exactly what we do, what we charge. So if you have any questions, you can always call me or shoot me an email. Love having cups of coffee with people, getting to know people. But you're welcome to check out the website as well. So, but yeah, a little bit about kind of the services we provide. I'll go over this briefly. We're going to talk mainly about real estate financial planning, and Kari had asked me to talk a little bit more about kind of the exit planning that we do. But like most financial advisors, we do comprehensive financial planning. A few years back, we kind of changed it up. We actually started offering a subscription-based plan. We did this mainly because we got the feeling it better aligned with our clients' interests. Unfortunately, there's a lot of financial planners in our industry who they'll offer either free planning, where you invest with them, and then they'll offer free planning. And we found that our experience with that is it hasn't always been the best experience for the client, because usually the planning either is forgotten about, or it's geared specifically to sell a product, which we don't think is the right way to do it. So we actually, a couple of years back, separated our planning and investment management and just said, hey, you know what, we're going to charge for it. And that frees up the ability to have clients. I have clients that only work with me with planning, and then I have clients who only work with me for investments, and then I have clients who do both. So the other service we provide, real estate financial planning, I'll get more into that. Investment management, we do your traditional, market traded portfolios. So stocks, bonds, mutual funds, ETFs. I do a lot of structured investments. But then one of our other niches, and why I think we've really kind of fallen into the real estate category or the real estate niche and kind of segment, is our experience knowledge with non-traditional kind of alternative investments. So these are with real estate, oil and gas, private equity, private debt. We do opportunity zone funds. Not everybody in our industry offers these. It's something that we've done for years and had very good luck with. And that's just, I think that's one of the reasons why we do attract kind of more real estate entrepreneurial type individuals. And the last service is, this is just kind of where we fit everything else. We get a lot of calls for, hey, I've got this one specific question, or I need this one specific product, and that's kind of the a la carte solution. So just kind of going through, I always like when I'm doing presentations, at least when I'm watching a presentation, I kind of like to know where the person's going beforehand, because I have an easier time following it. So just very quick, I'm going to talk a little bit about why real estate investors. I'm going to talk about our client types, because I found that kind of helps people understand more what we do. I'll talk specifically about real estate financial planning, kind of our exit planning process. I'll give you a detailed property analysis example. It's one of the things that we do a lot for clients when they're in the subscription planning or if they're working with us. And then the last thing I added, I get a lot of phone calls from people after the fact, after they've sold and they want to plan for it. And sometimes it's worse situation than others. So I kind of had an ongoing list of things that I wish I'd done before selling. It's just advice when you're thinking about selling, from a financial planner who specializes with real estate investing, what I would consider doing before you sell. And then last, I'll talk about our prices and then I'll talk about the investor network that we have, which you guys are all welcome to join. So with that, I'll kind of move right into it. So like I said, we started this business started about 1986, and about 20 years ago, we kind of started looking at our client base and realized there were a lot of similarities with our clients. They were primarily real estate professionals, owners, and operators. And after kind of looking at it, we realized it really wasn't a fluke. We feel it's basically because we were very like-minded individuals and we were attracting them. All of us in the business have owned our own property, managed our own property. I've done flips. I've had renters. Currently, we own properties that we lease, or we own our own properties. I do a lot of turnkey stuff with my own stuff now, the same stuff that I sell. But basically, we found that we were attracting real estate investors because that's what we believed in. That's what we've always felt real estate should be a core holding in a client's portfolio whenever it's prudent and suitable and possible, basically. So we don't think, unlike most people in our industry, we're not just invested in stocks, bonds, cash, and annuities. We are very much embracing real estate and other non-traditional investments. The other thing that kind of drew us to this niche is I personally feel like it's a segment that's completely underserved by our industry. Most financial advisors don't understand real estate. And in my experience, at best, they will either ignore it in the planning process because they don't understand it, or at worst, because they can't sell something associated with it, they will basically try and convince their clients to sell it and invest in the stock market, which I think is a tremendous disservice to the industry. So that's why we feel there's a niche that we've carved out that works really well, and it's something that we really strive to focus on and just be a champion for. And then the other thing I've also found out, a lot of the, I don't know, this isn't everybody in the industry, but I know a lot of real estate investors that I've worked with are deal chasers. They love it. They get a high from finding a good deal, buying it, and they do a great job. But I think some of them can benefit from more of a forward-thinking approach. I'm a big advocate of planning. And I think working with some of the clients that I've worked with where they're deal chasers, but when we actually sit down and model out, when they're looking at a property, okay, what's this going to actually do to my complete financial picture down the road? Is it going to help it or hinder it? And then doing regular, keeping kind of doing regular checkups, making sure that we're on our plan, it helps them advance more efficiently to what their end goals are. So like I said, over the years that we've been doing it, we kind of have grouped our clients into kind of three client types. I'm going to focus most on this presentation on the seasoned investor. We work with real estate investors at every spectrum. From just starting out aspiring to kind of approaching that they're kind of sick of the day-to-day management and kind of want to start winding down. They're kind of at that sunsetting out of the industry, and everything in between. So this is just kind of, these are the categories that we've kind of broken into and the type of planning that we do. So for the aspiring real estate, like I said, it's people who are just beginning. They've got a desire and a passion to invest in self-managed real estate. So for them, the strategy that we take on is more of an acquisition planning. So we sit down with them, figure out where their goals are, and develop and implement a customized plan to acquire self-managed real estate. The established and growing real estate investor are people who have they've purchased property, they know what they're doing with it, but they don't have an overall cohesive plan in place to get to the end result that they want. So what we do is we sit down, we'll analyze their real estate from our perspective, and then kind of tie it into the plan. And then we work with them, we partner with them a lot of times through the subscription planning, which I'll get into, and basically help them along the way. Look at future acquisitions, look at when it's time to get out of a property and move on, whether they sell, they exchange, whatever, or they stay in it. A lot of the software that we use, we've got two software programs. One is more of a financial planning focused one that has a real estate build out. And then we have a pure tax planning program that we do a lot of analysis for return from a tax perspective. And we'll take a look at that and really kind of dial it in and make sure that they're acquiring in the most efficient manner. And then the last, the seasoned investors, these are people who are kind of winding down. They've been around the block. They know what they're doing, but they're kind of sick of management. They're sick of those the 3 T's, and basically they're getting tired of the demands of active management for whatever reason. And they're interested in transitioning to a truly work optional lifestyle. So we sit down and kind of develop a plan of exit for them. And it varies in what it is, but its pure focus is exit planning. So a little bit kind of explanation of a little bit further explanation of the client, the type of clients that I work with for exit planning. Like I said, it's the people who are trying to eliminate the stress of property management. So they want to say goodbye to the tenants, toilets, and trash of owning real estate. It's also, I think the second one, take back your time. I think this principle that a lot of things I do in life seem to always come back to that 80-20 principle, that 80-20 rule. It's that Pareto principle, where I find a lot of individuals, especially who own property, they're whether they realize it or not, they're spending 80% of their time on 20% of their properties. So if we can eliminate that hassle and free up the time, they can spend it to doing things that matter more, that are more important, whether it's hobbies, spending time with loved ones, or purchasing additional property. It really kind of varies. And then the last one is, I get a lot of people for exit planning. Is there a plan in place for your real estate if something happens to you? And this, I've got a handful of clients right now that I'm working with that, for whatever, a lot of times it's a health scare. It's you got 2 spouses where one spouse is very knowledgeable in their real estate portfolio, the other spouse isn't, and there's a health scare, and the spouse who's very knowledgeable realizes, what happens if I get taken out of the picture? We need to figure something out. So this really addresses, the exit planning really addresses the problem of, okay, will my heirs manage the properties, or will they be managed by the properties? And that's just where I found the type of clients that I'm working with, it resonates with, because they don't want their whether it ends up going completely to a turnkey solution property management company, they need help figuring out a plan in place if something were to happen to them. So let me grab the next slide. This is an outline of the entire exit planning process. If you go onto our website, the acquisition planning, efficiency planning has its own set steps. I'm going to dive in more deeply into the exit planning process. But this slide just kind of outlines, with this particular one, there's about 7 steps that we focus on. The first step, and we do this with all of our planning clients, and any advisor that you've worked with has probably done this. We take it from more of a real estate perspective, but our goal is purely to understand the client's priorities, what they value most, and develop a plan that meets the needs. When it comes to exit planning, the questions we're going to ask you and the areas that we're exploring are, what kind of exit are you seeking? Are you looking for a total? Are you looking for a partial? Are you looking for immediate? Do you want it more spread out? We want to know what concerns you have. We want to understand. We want to know what keeps you up at night. What are you worried about? Whether it's maybe inflation or what are you concerned about? We want to understand it. And then also very important, we want to understand what lifestyle you need to support, because as you're transitioning from active involvement can be very difficult, or can be difficult sometimes. It's letting go of the reins. And we want our clients to exit at a pace that's both comfortable and also financially wise. And that takes planning and sitting back and figuring out, okay, what are we comfortable with? Which property makes the most sense to get out of first from a financial perspective? Which ones are more marketable? That's where we would tie in a real estate professional, but doing it from a plan and a position of strength rather than kind of haphazard or reacting to it. So that kind of leads us into step 2. We do this for all of our exit planning clients and our efficiency planning clients. Basically, we'll go through and we'll analyze and evaluate the real estate portfolio. Like I said, we do this with our tax planning software that we use. And I'll have an example of the property report that we run. But our goal is to provide an objective evaluation of all properties within the portfolio. And when I say objective, it's because I've worked with a lot of clients before where they come to me and they give me their properties, and I know in that initial interview that they think property A is their best and property C is their worst. And then when we actually run the numbers, it turns out it's reversed from a financial perspective, because we try and take the emotion out of it. I'm a third party objective, just looking at it. We do the analysis based on the individual property level and then also the entire portfolio. So you're going to get, when I'm calculating out debt coverage ratio, I'm looking at a proper individual property level, but then also as a whole. So you can see which properties may be bringing your portfolio down, which ones may be holding it up. We'll look at cash flow and performance. And when I look at this, I'm looking at from a tax perspective as well. So I'm looking at your before tax return, your after tax return. We'll look at your return on equity. I'm going to look at the debt structure. What's your interest rates? What are you at? When we use all of these reports that I'll show you, they project out over 50. They project out these numbers over 15, 20, 25 years. So we use them a lot for pinpointing, knowing kind of when a property is maybe prime for either refinancing or a property is prime for maybe selling. It's matured to the point where we need to move on. And then we'll also look at the potential tax consequences of disposition. We're always taking into account taxes and everything that we do. And then the other criteria, I kind of laugh at this, but it's the PETA scale. We call it. It's a very scientific measurement calculating the degree to which property is a pain in the ass to manage. So basically, we're looking at, okay, which ones, if like I've got one client who's got 75, 80 properties, and we're working on exit planning, and we just started with the ones that were the most pain in the ass to manage, essentially, and kind of worked from there. But and then we'll also look at potential risks, and by risks I mean which properties have maybe need some repair or maintenance that are expected down the road, or maybe the tenant situation isn't the greatest, or maybe there's not as much diversity, or meaning it's a single family home versus a multifamily home. So there's not as much diversification in the pool of rents that you're receiving. So there's a lot of different things that go into it. Once we have that real estate analysis done, then we kind of shift back to the more financial planning aspect of it, and we prepare what's called a real estate focused current situation analysis. This is very similar. It ends up being similar to what we do with just traditional comprehensive financial planning clients. However, it's purely focused, the real estate aspect kind of gets driven into it. And we're looking at how your real estate portfolio impacts your entire financial situation so we can understand your bottom line. So we're going to look at all of your income, expenses, savings, investments, liabilities, insurances. We do take into account what real estate depreciation is doing, what taxes are doing. And then as we model out, we're going to look, if you're looking for exit planning, we are going to look at your retirement income and how best to take retirement income from a tax efficient approach. We're going to run out Monte Carlo simulations, which each variations, and then we're going to stress test for things like, what if there's a raise in interest rates? What if there's a health scare or a long-term care need, or what's lower than expected returns? We're going to take all of that in that we normally would with our financial planning clients, but we're adding in that real estate piece to it.
Hey, Dave,
Yeah, go ahead.
I know what it is, and I'm sure many people here know what it is, but can you explain a Monte Carlo situation or simulation? Because
Yeah.
maybe some of these folks don't know.
Yeah, so a Monte Carlo simulation, I don't want to get bogged down with the technicality. It's a statistical analysis, essentially, is what it is. So what, in the easiest way that I've explained it or had it explained in the past, is what it does is it takes historical trends in markets, in different markets, over the past, as long as they can go back, 30, 40 years. And it'll run 1,000 simulations, okay? Based off of different randomly generated variations of, okay, this segment of the market returned this other segment maybe returned less or had a negative return. And it'll run 1,000 scenarios, essentially permutations of your plan with different historical returns. And then it tells you the percentage of those plans that succeeded based off of the parameters that you set. So if our goal is if we're looking at it from more of a cash flow perspective, which is what we do, we say that, okay, we're going to run let's say you're we're going to run the Monte Carlo and say that from now to the planning horizon, which is a fancy word for the end of the plan, when both individuals pass away or this individual passes away, how many of those years were 100% funded and how many weren't? And it'll give us a score, basically. So if 98% of those years were 100% funded, your Monte Carlo score ends up being 98%. If 85% of them, so 850 out of the 1,000 were 100% funded, your score is 85%. Now, 85% doesn't completely mean a horrible thing, because the Monte Carlo will trigger a failed run if it only missed 1 year or 2 years underfunded. Does that help, Kari?
Yeah.
Okay.
So it's the likelihood of you running out of money before you die.
Essentially, yeah. It's the probability. It's actually a probability test. It's the probability that your plan will be successful.
Okay, I got to dumb it down for me, so.
It's fine. Yeah, thanks. I get in the weeds when I start explaining stuff because I deal with it every day. But yeah, that's a good explanation of it. So we will run that, and that actually, the software that we use, our clients log in, and that gets updated every day, basically. So if we have a plan in place, they log in and hit refresh, and it tells us what the probability of success is based off of the plan that we run. And it's something we pay a lot of attention to. So once we've figured that out, we kind of move into, we know where you are, and we've kind of run it through. If nothing, I'll go back, sorry, the current situation analysis, this is basically saying, if nothing changes, this is what things will look like into the future. That we have a starting point, so we can move on to the next step where we actually sit down and we develop your strategic exit plan. And basically what we're going to do is we're going to sit down and work with our clients to develop, to plan an exit that's on a timetable that's suitable to your needs and financially wise. You're going to hear me say that a lot because that's what I focus on. I want it to be suitable to the needs and then also financially wise. Financially wise is a big thing, because selling everything all at once is not always the best option. Or, I mean, we want it to make sense financially from a tax perspective. And then what we'll do is, for each transaction, when we're doing this exit, we take a look at everything and we try and weigh the pros and cons of, is it better to sell? Is it better to exchange, to do a 1031 exchange? Or is it better to retain the properties? We'll kind of look at the different options, which is better. And if needed, we bring in, and this happens a lot, it's not even if needed, we'll bring in vetted specialists that can be involved to help develop and implement the plan. So I'll bring in CPAs, I'll bring in investment real estate providers, property management firms, real estate agents. Example, Kari, if I have somebody who wants something with multifamily, kind of smaller multifamily, if they're acquiring properties, my call usually is to Kari, because I know it's her niche and her specialty. I look for, and you'll find this if you ever work with me down the road, I look for people who are specialties in their area. When it's investment real estate providers, I'm looking for, and I'm providing the properties or working with these companies, I'm looking for managers I'm a manager picker essentially. So I'm looking for people who have a niche with multifamily, or a niche with storage facilities, or a niche with whatever, you name it, they stick to what they know. So that's kind of what we'll do. We'll build a plan that works. Once we've got it in place, planning is worthless without implementation. So my job through the subscription planning is to basically help implement, and I'm here to help assist with implementation as much or as little as requested. Some people just come to me for the plan and they go implement on their own. Other people are looking for us to help. Ways that I can help: I can provide turnkey real estate investments in a tax efficient manner. That's a fancy way of saying I offer DSTs, which are Delaware Statutory Trust. They're only available to accredited investors. That's a whole nother presentation or a whole nother conversation.
Okay, but Dave, can we say what defines an accredited investor?
Yeah, definitely. So an accredited investor is an individual or a family who has $1 million net worth exclusive of their personal residence. So if you take all their assets, all their liabilities, it nets out to $1 million exclusive of their personal residence. Or the other way to qualify is if you are an individual income. So if you're married and filing jointly, one of the spouses needs to make at least $200,000 a year in the previous 2 years, with a reasonable expectation of continuing that in the next year. Or if you're married filing jointly and you want to file, and you can qualify on both incomes, but both spouses have to make a total of $300,000. So both spouses can make $150,000, but that qualifies you from the SEC, because everything I do are securities when I'm helping provide the real estate. According to the SEC, you're considered an accredited investor, therefore you're a more sophisticated investor from their perspective. And it opens the door to some other avenues for investments, and DSTs are just one of them that are conducive to 1031 exchanges.
Now you set me up for the next one. So let's say we're lucky enough that we are accredited investors. What is a Delaware Statutory Trust?
So a Delaware Statutory Trust, it's securitized real estate. And what that means is it's a pool of investors. It's turnkey real estate or mailbox money. So essentially,
so when you say turnkey, what does that mean?
That means you are a limited liability owner of the property. You basically you do not get your hands dirty with the maintenance, the management, anything. You basically go into the investment, and there is a company that is managing that property, and you are still maintaining all the tax benefits of owning real estate. So you get to continue to collect the income, take the depreciation, take the deductions. You can have the tax incentivized, or basically the tax treatment of the gain, or you can continue to 1031 exchange out of it, but you have no day-to-day action in responding to tenant calls, deciding what maintenance needs to be done. That's completely turned over to the manager. So the other benefit of it is, or the one other thing with it is, you're going in with a pool of investors. When they first came out, I think it was 200 investors, then it jumped up to 2,000 investors. Now I don't think there's actually a limit, but generally you're participating with a large group of investors to own generally a larger property. The ones that I use are generally they're 200, 300, maybe 500 unit multifamily, or they're large distribution centers, or they're commercial. I mean, you name it, the type of real estate, we've done it. But there's medical office buildings, things like that. But what you're essentially getting is a sliver, your proportionate sliver for it, but you do have to be accredited to get into it. And you basically, when clients are going into them, they are selling their property, taking the proceeds, and going into something like this. And they are illiquid investments. That's one thing. And so it's the analogy that I've used to describe an illiquid investment. It's like dancing with a gorilla. You're not done dancing until the gorilla's done dancing. So you better know that gorilla. And that's where, when I mentioned in the past, I really focus on managers. I consider myself a manager picker. The companies that I work with in these types of investments, we've worked with them for years. My father's worked with a lot of them back into the late 80s, early 90s. And they're ones who have a history and a track record with what they've done. And we've got clients who are routinely reinvesting with them.
So basically you all sell your duplexes and you exchange it. You're lucky enough to qualify for a Delaware statutory trust and you buy the Mall of America together, right?
Sure.
But up front, you agree you're going to own the Mall of America for 7 years or 10 years or whatever it is.
Mm-hmm.
And there's no getting out of it, right?
Yep. Yeah. The one caveat with a DST is if you ever want to research them a little bit more, look up the 7 deadly sins of a DST. There is a lot of times with a lot of them, there is a defined life because and this is getting more in the weeds with it, but yet generally, yes, the timetable is about a 5 to 10 year, 10 to 12 years. They can't refinance. So sometimes the ones that take on loans, there'll be a more definitive life as opposed to the ones that don't take on any loans. They could be continual. Like you're at the mercy of the manager, basically.
So basically, if something happened to you where you needed the money or you passed away and you wanted to leave it to your kids would be bound for that same time frame. But conversely, you get a certain rate of return and you don't have to do anything.
Exactly.
And you avoid capital gains and depreciation recapture.
Yep. And you can continue that estate planning process of doing 1031 exchanges, which is what a lot of people do. They're deferring the gains consistently. And then, yes, and if something happens to you, your heirs basically pick up as owners and they continue to collect the rental income from it and the tax benefits. And they will get the step up in basis, which is the tax benefit. So when it sells, they will potentially not have as large of a gain as you would have if you were to sell it and not do an exchange. So
they'll just pay inheritance tax. Yeah.
Yep. So on current tax laws, and that's why people do them essentially. So so we were there any other questions with that, Kari, or?
No, does anybody have any questions? Because it's kind of a complicated thing that I've worked for years to just try and dumb down so I could understand it. So you got questions? If not, I'll let you go on, Dave.
Sure. Yeah, and I do these on a regular basis. That's a large portion of my business. What I'm talking to you today about is more the planning process, but a large portion of my business is just helping clients do 1031 exchanges with these properties, accredited investors. So with that said, so ways that we help, we provide, in addition to the planning, we'll provide turnkey real estate investments when needed. I will also provide opportunities to increase diversification through alternative investments. So like I said, I do a lot of oil and gas. I'll do a lot of private equity, private debt opportunities.
So can we exchange into oil and gas?
You can do mineral rights, but you can't actually do oil wells. So you can buy the rights to oil which are in the ground. Yes, that is something that you can do. And I get programs like that periodically. So that's one way to diversify, is exchanging into mineral rights. So yes, good question. And then with that, we'll basically introduce vetted industry professionals to help as needed. And that's always the case. So once that's done, the implementation, the sixth step, we monitor progress annually and before and after each transaction. So basically with any plan, periodic course corrections may be needed to keep you on track. One thing is always certain with planning is it's never static. So markets change, interest rates change, inflation changes, life changes over time. So we basically encourage our clients to meet us at minimum once a year, and then before and after each transaction, or if there's a significant attribute that's changed. A lot of times it's more frequent. It can be anything from a formal meeting to just, hey, this is what's going on. Let's talk. Let's adjust something in the plan. But that's what we encourage, and that's what we do. That's the active planning partnership that we're kind of building together. And then the last step, once this is all in place, it's really just kick back and enjoy life. That's what exit planning is about, is getting people to the point where they're not bogged down by the active management. They're in a situation that's tax efficient and helps them continue to have exposure to real estate. This quote from Mark Twain is one that I like. I'm kind of a sucker for quotes, but it's 20 years from now, you'll be more disappointed by the things you didn't do than the things that you did. So it's a lot of the clients that I've worked through this exit planning, we've freed up their time to be able to spend time with their families. to be able to do, maybe they had planned on they had built up a real estate portfolio that they planned on their kids taking over, but their kids weren't interested in it. Now they can free up the time to do stuff with their kids that they're interested in. So that's kind of, that's the end goal, really, is what it is to kind of help. We focus on improving quality of life, essentially, is what my goal is. This is an example of the detailed property analysis. I just included it so you guys can see. We'll run these, like I said, on all properties in the portfolio. And it's really just designed to help individuals know how their property is performing. So we do, like I said, the total return breakdown. We'll project out the debt coverage ratio at an individual property level, and then the portfolio level. We'll do before and after tax cash flows. We'll figure out what tax savings are. So this is just I just included this so you guys can see it. Let's see, I'm looking at time. Okay, we're doing pretty good for time. This is the one thing, like I said, I kind of built this list because I've gotten a lot of calls from people after the fact, and I just developed the list of the things, me as a financial advisor, who deals with real estate, the sold properties, what things I wish, or I do, and I wish I'd done before selling. The first one, I can't emphasize it enough. If you're going to sell, know how your property is performing. Prepare a detailed property analysis. Whether you come through me and I help you do it, or you do it on your own, just do it. Know what your bottom line is. What I do find a lot of times is people sell, and then because of certain circumstances, they're trying to exchange or something, they end up getting into a property that's not as good as the one that they had. So if you know where you are now, you know what you have to get into. You have a better chance at reviewing the market, looking at what you possibly could get to replace the property, and know sometimes it's better to stay. Sadly, I've encountered that before, where you look. The second one, this goes without saying, it seems redundant, but consult your real estate professional. And when I tell you to consult them, I tell my clients, I ask them to get a market analysis, but I want to know 3 numbers. I want to know the highest expected price, the lowest expected price, and the average expected price. And that's not so much to know, okay, what proceeds are we going to be working with for replacing the property or where to go. It's more so for that next step, to get a tax analysis. If you take away one thing from me today, I tell this with everybody, all of my clients, and I tell this to people I meet off the street or when I'm standing at a booth and talking about real estate financial planning. Before you sell, get a tax analysis, and go to your tax professional and ask them specifically, what are the tax consequences of selling? What are my estimated gain? What's my estimated depreciation recapture? Because this is taxed at a different rate. What's my estimated federal tax liability? And what's my state tax liability? I can't tell you how many times I get a client in the door who is dead set on selling, and then we get them to do a tax analysis, and they realize if they sell and don't complete an exchange, they're going to lose the majority of it to taxes. And then on the other end of the spectrum, I'll get somebody who comes into the door and they are dead set on doing an exchange. And then we actually run the tax analysis, and we find out that if they were to sell, the tax liability isn't very significant. And by going into an exchange has its own nuances, because it's going to tie you to rules within the IRS. It's going to tie you to a time frame that you have to jump through hurdles. And it's also going to, there's also expenses associated with paying the facilitator, the exchange, the qualified intermediary. Sometimes it's just better to sell it. And I've had that conversation with clients where, you could do an exchange, but it's maybe not worth, maybe you should reconsider it. But it's a case-by-case situation. The fourth one is, if exchanging, know the IRS rules, or partner with somebody who does. That's going to help you kind of walk through the exchange and make sure that you're doing everything right. Know the timing deadlines, or partner with somebody who knows that, so you don't get caught off guard with that. And if you have questions about that, you can call me. I'll walk you through it, or I'll bring in our CPA to walk through it. Know the facilitator's expenses. A lot of people, I said this before, but a lot of people kind of overlook this. That is something to consider when you're doing the analysis of whether or not to sell. And then lastly, have a plan B. A lot of there's a question of, if you're doing an exchange, what happens? People go into it saying, okay, I'm going to exchange this property. This property looks great. Well, what happens if that doesn't happen? What happens if it falls through? Have a plan B. I work with a lot of my the acquisition planning and efficiency planning clients. When they're exchanging, they'll come to me for a plan B. Basically, they'll maybe find 2 properties that they think they're going to exchange into, but then they come to me for a third backup, basically. And that just has helped. If you don't have a backup plan for it, or the clients who have had the backup plan, it helps salvage a failed exchange. So with that, I'll just quickly go over for what we do this is all on our website, but annual planning subscription, we usually charge $3,000 for the first year, $1,500 for subsequent years. That includes up to 5 properties. Essentially, it's just the second year is 50% of the previous one. If they just have more of a specific question, I charge $250 an hour, or I'll give a little bit of a discount if they do a 10-hour block. More information on our website with that. And then the last thing, if anybody is interested, we do have what we call our investor network. Welcome for everybody to join. It's basically name, email, phone number. What you get with it, we're not going to spam you. It's not marketing. We try to put out information that's relevant. So I'll put out a monthly commentary with a video. It's quick. It's a quick read. I'll put out a monthly educational video on various topics, something that we want to explore more detailed. I also will do timely emails on relevant current financial events. So some of the most recent ones that have gone out were talking about the Fed's move, raising the rates, or talking about inflation, what it's actually doing. And then you'll also be invited to educational events or happy hours, things that we do. If you are accredited, we have an accredited level 1, and that basically allows you the invitation to more exclusive educational and social events. And that's purely just from suitability requirements. So if that's something that interests you, it's a lot of the same benefits. There's some other meetings that we do that you would get an invitation to. It just requires an interview, a phone call, an interview to join. So if that's something that interests you, feel free to shoot an email to me or reach out to Kari. It's something you can unsubscribe from anytime, and I'm no harm, no foul, but I invite you to join our investor network. With that, thank you. I really appreciate the time. Any questions? Feel free to open it up to questions, or if you have something that you want to ask me on the side, that's my contact information. Connect with me on LinkedIn or give me a call. But yeah, Kari, thank you. I really appreciate the time. So
You're welcome. Does anybody have any questions specific to you or general, any way you want to cut it here? This is a chance to ask. You're very quiet tonight. Scott Molnar, I like your light fixture. I noticed that earlier, and the Montgomerys there, I thought that they had a fake backdrop, but they're actually outside. Got to be outside today.
Yes, I do have a question. What was my question? Oh, the DSTs. Do you come up? I mean, people. So, Kari, you had somebody on before, and so I contacted Morgan Stanley actually, and they sent me a thing, and it was oh boy, it seemed like it was a 500-page document that I don't know that I could make heads or tails of. But what's a typical like return that somebody could see on a DST, or does it vary? And how do you create that DST, or are there people that come to you and help you, or people that have these maybe that you work with that creates these DSTs?
Yeah. Typical return varies depending on investment objectives. So I have some DSTs that are more the term that I use to describe it, and more commercial real estate is more of a core holding, meaning that they're more income focused. So they're trying to maximize income. And there's 2 parts to a return with real estate, as you guys know. There's the income, and then there's the potential appreciation. So the ones that are more what I call core, or more income focused, are going to have more of a higher potential income stream from them, and then maybe a lower possibility of a backside appreciation. But then there's other ones that kind of focus a little bit more on kind of a little bit more value add. So initially the income might be a little bit less, but down the road there might be a potential for a larger total return or a higher level total return. So it kind of varies from program to program. And also varies as to where we are in the real estate cycle. And it's a case by case. Every one that we work on, or everyone that we do, you can look through the prospectus. And I actually I'll walk people through the prospectus on how to read it, how to understand it. And it shows pro formas for what they anticipate, what it's going to be. And then a lot of the programs that we work with, they have track records. So you can look back at the track records. Now, past performance, no guarantee of future return, but at least gives you an idea to what that manager's experience level is. As far as I'm not personally putting these together, I act more as a broker, a securities broker with it. So the difference with me is our niche has been this for years, and we specialize with this. And I'll tell you this, there are a lot of programs out there that I wouldn't touch. I think there's, at last I counted, there was like 100 providers right now, and we work with maybe 12 to 15. There's a lot of them out there that we don't, for whatever reason, they won't pass our due diligence department. There's reasons for it. So I tend to work with, like I said, I'm a manager picker. So I'm going to work with the program. I'm going to work with the providers out there that come to me and bring me a program that I have a track record with, that I've had clients have good experiences with, and basically that I have confidence in, essentially. So, but yeah, no, I'm personally not going out. I act more of a broker in this situation. But what I do is the experience of the people in our firm. We've cultivated relationships with these real estate investment providers, basically for years. So, and that's kind of how we do it. So yeah, does that answer your question?
Absolutely. And I hate to steal the floor, but can I ask one more? Do you, universal life insurance, do you work with that as well as part of?
Yep, when it's the right situation. Yeah, I'll do. I'd say, well, I'm licensed for all insurances. I in the right situation, it's one of those things where in the right situation, I think it's very good, and sometimes I think it's missold. And that's where I really kind of like when I do the subscription planning, because I give people a true objective opinion of what I think. I mean, for me personally, I actually own it. So, or I own it for myself. But it's one of those things where it's in the right situation, it can be good, but I think it's like anything in any industry, it's been abused in the past. So, so it's a case by case situation, but if you have questions, I'm definitely open to talking about it. So
awesome. Thank you very much.
Yeah, no problem.
Dave, Susan wants to know if you can explain depreciation recapture and how it's calculated.
Yeah, so do you understand how depreciation works? Or should I get into, how detailed should I get into this? And this is something
broad strokes, fat crayon.
Okay. And everything I'm going to couch it with, talk to your CPA or tax professional. I'm not I do prepare taxes, but I'm not a tax professional or CPA at this point. But essentially the way depreciation works, the IRS says that every business asset or every asset has a useful life. Real estate is your business asset. With you guys are all investing in real estate. So the IRS says that it has a useful life. So you can basically deduct a portion of it each year from your income, and you can lower your taxable income. So for residential real estate, it's 27.5 years. So let's just keep it simple. Let's say it's 27 years, and let's say you buy a property that's $27,000. Every year you can deduct $1,000 from your income. So if you're making $2,000 a year, the IRS says that you can take $1,000 to deduct against your income. So you're only getting taxed on $1,000 of that 2,000. The catch is, so each year you're getting, that's some of the tax benefits of owning real estate. So the catch is as you go, you get accumulated depreciation. So if you go 5 years down the road, let's say you've been taking depreciation for 5 years, you've accumulated $1,000 a year, so $5,000 a year. So when you sell that property, the IRS, if you don't complete an exchange, if you actually sell the property and pay the taxes, the IRS says that you owe recapture on that. And I believe it's 25%. And that's basically on top of whatever gain that you would make. So if you bought the property for 27,000, you turn around and sell it for 30,000, you would owe tax on the gain, plus you would owe tax on the recapturing the depreciation, which I believe is 25% right now, but that's something to look up for detail. Does that help answer the
Susan,
question?
does that help? I know she's looking for the unmute button. I know she is. Okay, we don't know. So,
and that's where I say do the tax analysis, because sometimes and go to your tax preparer and say, you ask them those pointed questions. And if you need help with communicating with the tax, because I know a lot of CPAs, they talk in jargon a lot of times, and we're all guilty of it in our own industries. But I'm more than willing to hop on the phone and help you figure out what you need. So.
okay. Roland, I see you have a comment here that as a small time, long timer with one duplex that you've owned since 1975 and refinanced, so you still have a mortgage, you're considering selling and getting out of the investment for good. Tax repercussions are a major concern on a totally depreciated duplex. You're trying to make the right decision, get out of real estate, question mark. Are you asking Dave that, or maybe you can help me out here, Roland?
Yeah, I guess so. Just as a general thing, I know I need specific numbers and probably an analysis, but that's kind of a general where I'm at.
Mm-hmm. Where I understand your situation. What specifically are you asking? Just.
Well, would using coming to someone, go to a tax person first and get all that financial information about what my tax liability and everything would be, and then perhaps that would direct me towards a different reinvestment in real estate or an exchange or something. I wouldn't have to be hands-on or something instead of totally stepping away. Would you help me make that kind of decision with that information?
Absolutely. No, that's exactly what I do. I've dealt with a lot of people in your situation where, yeah, it's a couple of duplexes or one, and we would take a look at what the tax consequences would be of selling that property and figure out what your options were, essentially. And that would be based on suitability. That would be based on what you would qualify for, and then also looking at the tax ramifications. And yeah, that's in a nutshell exactly what I do. And that's one thing where if it didn't warrant the full subscription, this would be like a one-off. We just do an analysis on that side of it. So for you. So, but more than willing to help answer those questions. It's what I do every day. So.
Okay, thanks.
It's Roland. So thanks, Roland.
All right. Nicole wants to know, or Colin does, how do you balance riskier financial leveraging with stable but lower growth? Ranges such as utilizing a line of credit from a second mortgage versus saving cash over time to purchase more properties.
Explain that one more time. Sorry, how do you?
Colin, do you want to?
Oh, yeah, I'll just jump in for this one. So basically, it comes down to like aggressive growth, use a second mortgage to pick up a property versus play it safe and just, squirrel away cash to grow that way without utilizing second mortgages. We're not big. We have 2 properties. And just like, how would you, from your perspective, approach a situation like this?
So I'd be looking at what the rates were, what you could qualify for. I'd be looking at what cushion I approach things when I'm doing planning. It's hard to answer without knowing the specifics.
Right. Yeah. I'm not looking for specifics, just vague generalities. That's just fine.
I would be looking at what your cash reserves were. I'd be looking at I'm going to be looking at what your debt coverage ratio is. When you're purchasing, looking at what the liability, or basically what the interest rate is for which you can secure financing. Those are the, I'd be modeling it out. I'd be doing, with really what I would do is I'd ask you a series of questions, and then I look at my system and use that analysis to make an informed decision on it and figure
Yep.
out. Yeah, does that help?
So potentially working with you to kind of figure out what the best route is for us
Exactly.
moving forward is probably what you'd recommend.
Exactly. Yeah. I mean, without, and I forgive me, it's hard to know because there's so many moving
Yeah,
parts.
right.
It's hard to answer it specifically, but yeah, no, it's something we would look at the numbers, and I'm just telling you off the cuff, I'm going to be looking at, okay, what interest rate can you secure? What's your current debt already? What's your monthly nut that you have to cover? I mean, I'm going to be looking at it from mitigating all aspects of risks, or as many aspects of risk that we can identify and we can mitigate.
Gotcha.
So.
Yep, that answers my question. So thanks much, Dave.
Yeah, no problem.
Anybody else got any questions?
I have one quick clarification and a question. The depreciation recapture happens via the IRS regardless if you do a 1031 exchange. So essentially, if you do a 1031 exchange, you still have to pay depreciation recapture. Is that correct?
No.
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 If you do the exchange, you're actually deferring it.
Ah, oh
That's
wow.
the benefit, is you defer. Yeah.
Oh, that makes it more juicy. I like that.
That's the reason. Yeah, and that's why people do it. It's really an estate planning tool. And I think did you have Jeff do the presentation before?
And he kind of came in like he was talking to a bunch of Harvard grads. I went to Arizona State.
Yeah, I've heard him. Yeah, I know. He goes into a lot of the history of it, and it's fascinating. He knows a lot of the history of the tax law and everything, and because it started back in the early 1900s. It's been around for a long time, but yeah, it's basically, in my view, it's an estate planning tool, because you're trying to defer taxes on transactions of real estate, to defer the gain so you don't lose your purchasing power as you're going. Because like, if you have to sell and pay taxes every time, let's say that your tax liability on average was 20 to 25% every time you sold a property. So you buy a property for 100,000, it goes up to 200,000. You're going to be taking a $50,000 bite every time that you do it. Where if you exchange, you get to roll that full $200,000 into the next property. I mean, and that's very broad with a CRAN, because there's going to be other expenses. There's going to be other transaction costs associated with it, But that's essentially what an exchange is for, is deferring. Under current tax law, it's deferring the gain to retain your purchasing power, so you're not losing out. Because the IRS sees it as real estate as your business. You shouldn't have to. From my understanding, and it's part of your business, and it's a business asset. So they don't want to hurt you as you're trying to increase your business, essentially, from my understanding on it. And consult this, again, obligatory disclaimer, consult your CPA or tax advisor for more details. So
You can also, if you are really small, my understanding is you could 1031 into, say, a house someplace warm, rent it out for 3 years, move into it for 2, and dissolve your gain and depreciation recapture back to the dawn of time. It would have to be your primary residence at that point, though. I believe that's how it goes. So that may be another alternative for some people.
I've heard of that before, yeah. So yeah.
So you want to be in Arizona or Florida or wherever you want to be, or up north, and kind of have a timeline of when you want to accomplish that by.
Mm-hmm.
And I can make referrals on really great short-term rental property managers. So if somebody wants to do that, anybody else?
Actually, Cara, I might grab that from you, because I got a client right now who might be interested in a property manager for short term. So
I've got somebody great.
Oh.
You want me to put them in the chat?
I'll shoot you an email later. It's all.
Okay, great. Anybody got any questions? So we know where to get, everybody's got Dave's info. If you have a question, you didn't feel comfortable asking him here. I can always be found at duplexchick.com, Kari at duplexchick.com. I'm hoping to connect I recognize many of you from the legislative meetings about rent control and all of the moving parts with the Twin Cities and all of the laws and new rules we have to abide by. And I'm hoping to have Marty back from the Minnesota Multi-Housing Association in the next week or two. He had been hoping to wait till the state legislature adjourned so we could know definitively where everything stood and he could give us a comprehensive overview. So look for that in the next couple weeks.
Sounds good.
All right. If not, everybody enjoy this beautiful summer evening or spring evening. I think it's supposed to rain tomorrow, so we better soak it up while we can.
Thanks. And if anybody wants to, I'll just say this, if anybody wants to grab a cup of coffee sometime, I love coffee, I love beer. So if anybody wants to grab a beer or something like that and ask for the
But you
question.
don't mix the two together, I hope.
No. Well,
That'd be
it's
gross.
coffee beer, but sounds good. Thank you. I appreciate the time.
All right. Everybody have a great night. If you want to rewatch the recording, Housing Providers for a Better Minneapolis on Facebook. And I don't see any reason why we couldn't put this on Duplex Chick in the Duplex Chick page on Facebook as well. So, all right.
Thank you much.
Everybody have a great night.
You too.